Okay, so I'm going to give a little bit behind, so I'm going to give a whistle-stop tour of this paper. So this paper, or this presentation, is all about microstructure of dark pools, particularly looking at the details of how their pricing rules are constructed. So essentially the design questions of dark pools. So for those, if you're sort of less familiar with dark pools are alternative trading venues which have grown in size and significance greatly in the last decade. They separate themselves from lit markets and more common financial markets in that they repress information pre-trade, and they do this to lesser or greater extents. At one extreme of the continuum, essentially they give no information to traders prior to trade, so you can't see any information about the prices or the quantities of orders available in the market. They're essentially completely opaque. Other markets may give you partial information. They might tell you trade price, but without available quantity. But in essence, they're dark. They hide liquidity information. There may be various advantages or disadvantages for this, in that they may allow large traders, well, the argument for them is that they allow large traders to conduct liquidity trades rather than information trades without having an impact on the market as a whole, because they can hide that volume. There are, of course, though, disadvantages with this argument. It's very hard a priori to separate out liquidity versus information trading. As a result, there are concerns from regulators on the impact of dark pools on information dissemination, on price discovery. The fact that trades are happening, or that orders are being placed, that the information of those orders is hidden and traders can't see it until trades have occurred, is going to limit the ability of other traders, other financial institutions, to accurately price and value the asset. Essentially, it's making markets more opaque, potentially at the cost of other market participants. If these markets were small, that might not be an issue. However, their size and importance across the major financial markets and economies has been growing notably. So, somewhere between 40 and 60% of trade occurs through dark pools. So these are major trading venues which can have a very large impact on our overall on the overall price discovery process. The rate of growth of these trade markets is also very high. So they were around 45% in the US in 2017, but that's a 50% 50% increase over time. The other difficulty we have with dark pools is that there's still relatively little work fully trying to understand them. They are difficult to approach analytically, and there's still relatively little information, empirical information available. So our understanding of dark pools is far weaker than our understanding of other financial trading venues. So what I'm going to talk about in this paper, I'm going to talk about whether the existence of dark pools is beneficial to traders and markets, both separately and together. I'm going to talk about where traders should prefer to trade. Should they prefer to trade in traditional lit markets, or whether they should prefer to trade in dark pools. And I'm also going to talk about how the design of dark pools matters. There are many design questions for institutions designing and creating dark pools. One of the most pressing is how the price is discovered. In a typical double auction market, price is determined by the price of the limit order, the order that was in the market first, essentially the liquidity giving order. In dark pools, there are many different ways that this can be done. That's one option, but we're going to explore other options, essentially taking price signals from lit markets. We'll talk, there's alternatives around using average prices, things such as the VWAP, and so on. So I'm going to talk about how the design of dark pools impacts this question. So I'm not going to say a great deal about the literature given the time. There are some empirical and theoretical studies looking at this. But as I say, the information is limited. They're also very hard to analyse analytically. So in this paper, we're going to be taking a numerical approach. We're essentially going to be setting up a game, essentially trading the dark pool as a game, and then using a sophisticated numerical technique to identify the Markov perfect equilibria of that game. We're then going to analyse that equilibrium numerically to understand the relevant market statistics. So I'm going to start off setting out this game. We've tried to design the situation, the model setup to be as realistic as possible within the bounds of tractability. I should say, I emphasise the bounds of tractability in this case, that whilst we're taking a numerical approach that lets us do much more than we'd be able to do theoretically, this situation is still sufficiently complex that there are still limits, that there are constraints on how complicated a model we can solve. So to put this in context, this model takes the best bit of a month on a very high performance machine to arrive at an equilibria. The results we're going to demonstrate are averaged over and contrasted across several hundred runs. So there's a lot of computational time to try and get these results. So the way the model works, we have two types of traders. Traders trading large quantities of the order and traders trading small quantities of the order. So in line with our essentially the common beliefs around how the different groups of traders particularly use dark pools. We have two markets. We have a lit market, a traditional double order book lit market, and a dark pool whose design I'll talk about in a few slides' time. I'm not going to say too much about the notation, but the lit market works based on a discrete set of prices. Traders can submit limit orders to the book, which specify a quantity, a price, and a quantity that they wish to either buy or sell. Other traders can then submit market orders to execute against those orders. In the dark book, the submission decision is simpler. All they have to do is submit a quantity and whether they want to buy or sell. The price in the dark book is going to be determined by the lit book in our case. So it's going to be determined by the prices in the lit book. So there is some information for the traders submitting to the dark pool, but importantly, they don't know what quantity is available there. So if they're wanting to buy and there is a seller in the dark book, they'll execute instantly. If there isn't, they'll enter a queue into the dark book and will have to wait. This waiting is important as it entails picking off risk, essentially both the cost of waiting and a risk to it. So priority in the dark book, the queue is going to be determined in one of two ways, either time priority or size priority. Both of these rules are used in real financial markets. Time priority is the most common. It's used in lit markets around the world. Essentially, whichever order entered the book first has a particular price has priority. Size priority is used in some dark pools. Essentially, whoever has the largest order in the book has priority. So this gives priority to large traders over small traders, effectively. So I'd just like to sort of give you an idea of the different information sets available to traders. So in the lit market, given that the trader can see the best bid, the best ask, the depths at those prices, they can deduce the price in the dark pool because it's the mid price of the bid and the ask. They can see the total quantity available at the buy side, the total quantity available at the sell side, and they've got details of previous prices and transactions. In the dark pool, all they know is the price. And they don't know, for instance, whether the execution would be instantaneous or whether they'll be entering a queue. So there's a very different set of information. The trader's submission decision when they enter the market is then which of the two venues do they submit to, what's the quantity of that order, and if it's in the lit market, what the price of it is. So the traders enter the market. There's a continuous stream of traders entering the market. They enter at randomly determined times, with the time between entries being determined by a Poisson distribution. Each trader is risk neutral, and they arrive with a private valuation of the asset, which determines which is going to affect their submission decisions. They can't continuously monitor the market. However, after submitting an order, they re-enter again at a randomly chosen point in the future. So the trader's decision is both, what order should I submit when I enter? But in making that decision, they have to factor in the fact that they will re-enter the market, and if they're not happy with their current order, they can adjust it. So this is essentially, it's a dynamic programming problem. So it's a series of decisions to try and maximize their expected return. Small traders buy or sell 1 unit of the asset. Large traders buy or sell a quantity which is greater than 1. The way the traders submit orders based on their strategy. We use a numerical optimization technique to identify the optimal strategy of traders. So they take all the information available from the lit and the dark book that they can see and submit the optimal order. So I'm going to skip ahead a few slides. In order to work out this strategy, we're essentially identifying Markov perfect Bayesian equilibrium. The estimation technique we've used for this is somewhat, let's say, long-winded, in that it takes about a month to run. But what we do is essentially optimize the trader's strategies such that the trader's estimate of their expected payoff from a given order matches their realized payoff over time. So it's a continuously improving optimization. We know we found an equilibrium when those expectations match realizations. Oh, sorry, I think there's a question.
Yeah, and quick query. So what is the information set for the agents? I didn't quite get that.
Okay, so the information set is all of the information about the lit market. So the best bid, the best offer, the 5 best bid prices, 5 best offer prices, the quantities at those prices, the total quantity in the bid side, the total quantity in the ask side, the most recent transaction and its direction, and the private information about the trader as well. So both the public and the private information. Okay. And all of that is taken into account in selecting a market price and a quantity. So I'm very quickly going to give some key results. This is easiest with figures. So what we can see here is the distribution of traders. So how many traders are trading in the lit market versus a dark market for different levels of volatility in the system. So I'm going to focus on this graph here, which shows it for the markets with both time priority and size priority across different levels of asset volatility. What we can see is that for low levels of asset volatility, the vast majority of traders are in the lit market. So up here, very few traders are in the dark market. However, as volatility increases, so the market becomes less sure, traders migrate towards the dark market. And this is particularly the case where we have the time priority rule. I'll talk about a bit more about that later. As volatility continues to increase, however, we end up with a migration again back towards the lit market. The reason for this is all to do with traders making a trade-off between speed of execution and picking off risk. So under very low volatility, the picking off risk is very low. So as a result, traders tend to place orders in the lit market to maximize the speed of transaction, and they have relatively little risk from displaying their order in the lit market. It's unlikely to be picked off. As volatility begins to increase, there becomes benefits to trading in the dark market because the dark market hides information about the trader's order. It reduces the picking off risk. What we find, though, as the volatility increases even more, we end up with a migration back to the lit market. The reason for this is that for very high levels of picking off risk, the way in which prices are determined in the dark market, so the midpoint of the lit market, is not beneficial to traders. It's better for them to be in the lit market to place orders either far from the current market price, or to use market orders and essentially benefit from immediacy. So dark pools are only essentially really popular amongst traders, are only preferred by traders for intermediate levels of volatility. So the other thing that's worth highlighting about dark pools is that they unambiguously increase liquidity costs within the market. So the existence of a dark pool is not beneficial to either to the majority of traders in the market or the welfare of the system as a whole. Essentially by fragmenting liquidity, the traders and the system as a whole loses out. Actually, the only traders to benefit from the existence of dark pools are what you would call speculative traders. So these are traders who essentially are trading for with no private value. They are just speculating, trading off the need of other traders to trade. So dark pools as a whole reduce welfare. However, if we look at the details of the design, the time priority rule is slightly better than the size priority rule in that regard. So the size priority rule is most harmful for, let's try that again. The time priority rule is most harmful for welfare, closely followed by the size priority rule. The reason for that is the size priority rule benefits the large traders as opposed to the speculators. So I think hopefully, I've just fitted into the paper into slot. I'm very happy to answer further questions about this, but that's in a nutshell. Those are our findings. The dark pools damage market welfare for large traders, but size priority rules do this to a lesser extent than time priority rules. Thank you.
Thanks, and very interesting results. There are, I guess, many questions. So first, Nikki follows, then Sherry.
Hi, Dan. Thank you very much.
Hi, Dan. Yeah. Sorry, Nikki first. Yeah.
Shall I go first? Okay.
Yes, please.
So, Dan, I was just, maybe I just wasn't sort of paying attention at that point, but when modeling the lit venue, did you take into account, say, the market impact? So, when there is a large order, the price will obviously adjust, or, whether it's a sell or a buy. What was that sort of included? And sort of the second part would be, in terms of, say, algorithmic trading and order routing and so on, are there implications for the design of that kind of software?
Yes, no, good questions. You're absolutely right. I skipped over the vast majority of the model and didn't talk about market impact. In answer to your question, though, yes. So we fully model the order book in the lit market. So when a large trader enters the market and submits a big order, they take away liquidity from the book, and that has an impact on the market and the price. So essentially, increasing the spread and moving the price. So it fully captures how you'd expect an order book in a dark market to behave and interact. Order routing is a really interesting question. We have an extension to this paper that we're working on at the moment that is looking at questions around preferencing and order routing more generally. The assumptions in here are relatively straightforward around, traders enter and then have the choice between market, the lit market or the dark market. I would think there are very interesting questions around intermediation by brokers in this case, and essentially paying for order flow and choosing where orders go. So that's essentially the next paper in this.
Yeah. Thank you.
Great, thank you.
Sherry? Yeah, so Dan, that was very interesting. I mean, the whole business of information being fragmented, centralized exchanges, the London Stock Exchange, fighting for their life against such parasitic sort of distilling away from their own centralized platforms. But the point is that maybe you couldn't cover it in the time. The market price discovery that's done on the centralized exchanges, is not what is done on the in the dark pools. In other words, they use the prices determined elsewhere, do they not? They're parasitic in that sense. So they are there for a purpose, because the statistic that you showed us, you can remind us again what it is, that this is happening in quite a large extent, isn't it? The hiving away of trades into dark pools. So if you can then explain a little more that you said the nature of the fact that they use the price determined elsewhere in the dark pools, right?
Yeah.
Okay.
No, you're absolutely right. I skipped over this, essentially the detail of this. So one popular and common way to determine the price in a dark pool is to take the midpoint of an equivalent lit market. So trade in the lit market directly affects the execution price for the dark pool. What this means is that as trade moves from lit markets to dark pools, there's less liquidity, there's less trade in the lit market. That directly impacts the price discovery process and the execution price in the dark pool. You can see that having fewer traders in the lit market means that the price, in a very real sense, will not be as accurate, either whether that's intertemporally or due to a larger spread, and that then will have an impact across the whole systems of market, so both the lit and the dark market. By moving trade to the dark pools, this is essentially the mechanism by which we're hitting welfare, or by which welfare is hit across the system, because you're inhibiting price discovery and you're fragmenting liquidity as well. So you're making the cost of trading higher. But
can you just sort of tell us, the dark pools are done by private entities, cartels of people. So what is the it's like, sort of like piracy in some sense. Is there any way we could prevent that by regulation?
That's a very good question. Yeah, you're absolutely right. So the dark pools are often set up by private entities. It's beneficial for them. They charge a trading fee, but they don't internalize the cost to the system as a whole. This is why there's a lot of interest in them from a regulatory point of view, because they're essentially, according to our results, extracting welfare from the system. Some traders feel I think certainly historically, some traders felt there was a benefit to them, particularly due to algorithmic trading in the lit markets. Our results would suggest from a system-wide point of view that that's not the case. So let's say we can show that in some circumstances, some traders do prefer to move to the dark pool. However, it would be
Sorry, and why is that? Why is that? So that the transparency is diminished, they can do things secretly that you can't actually do in a fully lit order book system, right?
That's it. For intermediate levels of asset volatility, there's a benefit to moving to the dark pool, because they can hide some of their information, and at the same time, if transactions occur at the mid price of the bid and ask spread, so there's a small improvement in transaction price, but they would be better off on average if the dark pool didn't exist. So conditional on the dark pool existing, they switch, but welfare would be higher if the dark pool wasn't there. So it has a negative impact on the system, and particularly on traders trading large volumes. However, let's say, unless regulators are going to ban the introduction of dark pools, or the trading them altogether, conditional on their existence, some traders will find it optimal to transfer to them.
I'll just read out a question from Aberban Banerjee. Any views on which market the traders with private information will prefer, Dan?
So it varies dependent on volatility. So there's the graph I briefly showed, for low and high volatility, they tend to prefer the lit market. For intermediate levels, they tend to prefer the dark pool.
So there is also a question from Amir Singh. What will be the effect of cartels to influence the dark pool?
So, sorry, cartels in what sense? Yes. Sorry.
Yeah. So Amir Singh, do you want to elaborate on your question? So cartel as a group of people.
So are you meaning you have multiple traders working together to influence the dark pool?
I think that is what I think Amir Singh is hinting at, that if multiple traders colluded, then could they influence the dark pool somehow?
Possibly. That's not something we particularly looked at. Maybe we should, I think, perhaps talk about that in more depth after the session. I'm very happy to discuss it. It's not something we've looked at yet.
And I have one question from my side. What was the intuition for this welfare effect? Can you go back one slide?
Yeah. Oh. Yes.
So here, the first observation, I guess. Yeah, I didn't quite get it. What is happening?
So in essence, it's a fragmentation of liquidity. So, it tends to, if you take the same number of orders and split them between two venues, it tends to widen the spread. So the cost of trading, or both in terms of the crossing the spread and the time until there's an acceptable order for you to trade with, both increase.